There's a lot going on in the market this week. Just like every week, there's a lot of earnings results coming out. On our website, our main page, if you're a subscriber, you can scroll to the bottom here and see by week what's going on, who's reporting by their logo. A couple of videos we're doing. One is Dick's. There's a lot of other sites. There's a lot of companies that aren't really big. We don't necessarily have to report on everything, do an earnings reaction on everything. We want to focus on the ones that our users and our software subscribers really want us to focus on. We do make the videos for you too. We do some for just our subscribers. But a big thing that's happening this week is Fed Chairman Powell is speaking to the Senate and then the House. I believe that's the order, Tuesday and Wednesday. Everybody hangs on his words. What are they saying? What's he saying? Is he hinting at raising rates faster than he said? Is he hinting at keeping things the same? The last interest rate hike was 25 basis points, which was lower than I expected. I thought they'd continue on with the 50 basis points. But remember, guys, on this channel, we are trying to focus on the long term. And that doesn't mean the long term the way the IRS calls long-term investing over 1 year. That's irrelevant. I'm trying to focus on 10 or 20 years, which is why when things are great, I usually don't think they're as great as people think. And when things are bad, I usually have a much more optimistic outlook because I don't believe that over 20 or 30 years of time, the U.S. will be worse off 20 years from now than today. I believe in the U.S. economy. I believe in the people in the U.S. Does that mean we don't have issues? Of course we have issues. We always have issues. Every country in the world has issues. The question you have to ask yourself is, what are the issues that matter and what are the ones that don't matter? If you look at interest rates on homes, for example, 2 years ago, my fiance got 2.625 on her fixed 30-year mortgage. That same mortgage today is 7%. That's very alarming. But it's only alarming due to the fact that we have now had such a big jump in interest rates. Just like if you go to the gasoline pump, and if gas doubled tomorrow to $6 a gallon, we would all be in hysterics. But if we had that for the foreseeable future, or instead of $6 a gallon tomorrow, we saw it go from 3 to 6 over the next 10 or 15 years, it'd be a lot easier to absorb. Okay? That's what we're trying to focus on. We're trying to focus on the long term of everything. When we look at a company, we tend to want to focus on companies that have a long, durable advantage that we can bank on. And we're looking for short-term mispricings in the market. That is the big key for us. Short-term mispricings. The larger the company, the harder it is to find really big discounts. The smaller the company, it's easier. Why? Because smaller companies are followed by less investors and less people. So it's much more likely to have major mispricings in that company. The larger the company, the harder it is to get major mispricings. Apple's much less likely to be mispriced than some other $100 million company. But it's also a lot easier to be in the crowd with Apple, right? Your neighbors have Apple, you have Apple, your friends have Apple. But the hard part will be if Apple fell in price by 50% tomorrow, understanding which data really matters. And that's what I'm trying to focus on this week. When the Fed speaks, the bottom line is inflation is still an issue. And the Fed should not care about the stock market. Absolutely should not care. And raising rates definitely does affect the stock market. But I have a concern that the Fed has become too much of a puppet of the public's perception of what needs to be done. I don't like that. What I want the Fed to do is stick with their mandate, which is unemployment and inflation. Focus on those two things. Unemployment right now is way too low. You might sit there, hear that going, wait, what? Yeah, unemployment is way too low. When more and more people have jobs, there's upward pressure on wages, which causes inflation because people make more money, so they have more money to spend, and more money is chasing the same amount of goods. And the cost of those goods increase because wages are going up. It just works all together. So inflation is going to be an issue for a while. Where's it going to go? I have no idea. All I know is that when you have low unemployment, it tends to lead to inflation. That is an issue that the U.S. has to deal with head on. And how do you deal with that? By raising rates. Now, what are some of the benefits of raising rates? Well, Right now, if you just Google something as simple as 90-day treasury rate, right now, the 3-month T-bill is 4.74%. 4.74%. That's annualized, not over 3 months. You're not getting 4.74% over 3 months. You're getting 1.185. I don't know if that's right or not. I think that's right. It's 4.74 divided by 4. That's 174. Yeah, I'm right. 1.185 every 4 months, every 90 days. Just 2 years ago, it was this. 0.06%. That meant for every $1 million you had in treasuries, 1% is 10,000. 1% of 1% is 100. You got $600 every year for every $1 million you had in cash. Nick just laughed about that. That's how hilarious. Now, that same treasury of 4.74, you get $40,740 every year compared to 600. Now, back then, stock prices were high. Why? Because I'm like, oh, listen, I can get 2% dividend yield by buying stocks. It beats my $600 here. $1 million bucks, I'm gonna get 20,000. That was not the way to look at it. Because to me, that's what drove all asset prices so sky high. Real estate prices went high. All speculative investments went higher and higher and higher. All investments went higher and higher, and the speculative ones became even worse. So my guess is, if you look at 1980 or so, when we have 15 to 18% rates, and recently we had 0%, you saw rates just go down like this for 40 years. So what's going to happen? Well, the pendulum has swung from one extreme to the other extreme. Now, I don't know where interest rates are going in the short run, but the 10-year treasury on average is about 4.5%. The 10-year currently is 4%. All right, we're a little bit under, but we're going to go up and down, up and down. And the U.S. Fed is going to raise and lower interest rates based on where they want the economy to go, unemployment to go, and inflation to go. Now, don't get hung up too much on the day-to-day comments by Fed Chairman Powell. You're going to be chasing yourself and worrying too much. What I would focus on in the long run. Right now, the 10-year treasury isn't that far below historical average, but we went to an extreme on one end. So what does that mean? Are we going to go to the other extreme for a while? I don't know. But I will say that the other extreme led us to the lowest valuation mark in history, 1982. 1982 was the lowest historical valuation metric in the S&P 500. We were about 32% total stock market to GDP, and today we're at about 120% or 100, whatever we're at. We're 60% overvalued right now, according to my chart that I've done. So we went from basically 40% undervalued to 60% overvalued. That's a lot of swing. Now, the good thing about inflation is GDP goes up and up and up. Nominal GDP goes up. That means your income is going to go up. So when inflation is finally tame, you've gotten the benefits of raising your income level. Raises housing prices, all these things that happen. So nothing is just in and of itself good or bad. But everybody's going to be looking at this the Fed chair and in the market this week. Also this week, ADP payroll numbers. That's going to be important for people in the short run. But again, I just foresee us having upward pressure on unemployment because it just has to happen at some point. You can't have 3.6% unemployment for too long. It's just going to lead to massive inflation, which will lead the Fed to raise interest rates, which will keep the economy tempered down. Consumer credit comes out this week as well. We've seen a lot of money put on credit cards lately. We've seen a lot of things like that happening. Why? Because inflation was so high and people's incomes took a little bit of time to react and recover from that. So a lot of people swipe their credit card to pay for the larger increases in their lifestyle. Guys, it's not FUD. It's not fear, uncertainty, and doubt. It's just reality. You can't go from one end of the pendulum just to the middle and go back up again. It's just not going to happen. And you can't stay at another end of the pendulum forever. And the good news is when there are bad times, then I'll be the guy saying, guys, we're going on this end of the pendulum. It's not going to stay this way forever. Be cautious, be optimistic, but also be aggressive on the areas that are fundamentally true and good, which the U.S. economy is. And that's the big part here. Guys, if you like this, I want you to do two things for me. One, I want you to subscribe to our channel. And two, I want you to share this with somebody who might get some benefit from listening to the message right here. Thanks, guys. Take care.